One of the most popular ways to trade options is to sell credit spreads and sell iron condors, but we also know that we do not need to do that. We can also sell naked options, but we tend to use spreads as a way to limit the losses in case if the market tanks or something bad happens. That's why in this video I wanted to compare selling spreads to selling naked options to see if there is one that is better than the other. And if you like this video and you like to see more videos like this one where I compare, for example, certain types of trades, don't hesitate to subscribe to my channel and like this video. That really be the best support you can give me. And one of the main reasons the options traders usually prefer to sell spreads instead of selling naked options is because of the capital requirement. And it's true that if you compare, for example, selling a naked put on Facebook compared to selling a put credit spread on Facebook, meaning that the only difference is that we buy the long leg so as to limit the losses, well, you can see that there is a huge difference in the capital requirement. On the one hand, you have thousands that you have to put on the table just to open a naked put, and on the other hand, you just need few hundreds depending on the width of the strike that you're choosing. And you can see why it's so attractive to so many options traders, because why would you bother selling a naked options and putting so much buying power on the table when you can just sell credit spreads, put 5 times less buying power on the table and still make even more money? But as much as naked options are criticized for the capital requirements, meaning that we saw for the Facebook example that for a credit spread you needed $400 and for a naked put you needed $2,000. Of course there is a huge difference, but here's the thing. The moment the market goes against your credit spread, meaning that if you sold a put credit spread, meaning that you're bullish on the market, the moment the market tanks, it's going to be very hard for you to roll out your credit spread to a later expiration so as to give yourself more time to be right, and it's going to be almost impossible to roll it for your credit. And small reminder here, rolling for a credit means that you're going to increase your max profit, reduce your max loss. So ideally you always want to roll a trade for a credit, because otherwise you're going to increase your max loss, which is a bit counterintuitive. And that's really the problem about credit spreads, and I feel that so many people just forget about this, is that it's very hard to roll credit spreads. And at first I was also very confused about this, because I was like, okay, if you just need $400 instead of $2,000, why don't I just sell 5 credit spreads and I can make 5 times more compared to just selling one put? And that's exactly the problem that I face, is that the moment the market went against my, for example, a call credit spread or put credit spread, I was stuck with like losses and I couldn't roll them out in time, so I was just stuck there with my credit spreads, impossible to roll them, and I had to take all those losses. And that's why I realized that yes, as much as credit spreads are great in terms of capital requirements, you can't roll them out and you can't turn those losers into winners. So what does that mean? Does that mean that you should always take the max loss on a credit spread and that you shouldn't even try? No, I'm not saying that you shouldn't try. I'm just saying that it's going to be in general very hard to roll out a credit spread for a credit, and it's usually a loss that you're going to have to take in the end. And to illustrate what I'm saying, I have a call credit spread right now on IWM that is expiring in the November expiration, and it's just in the money. And it's not super far in the money, but the 2 legs are just now in the money. And if I try to roll it out, you can see that to be able to roll it out, I have to pay for that roll, and that really goes against the purpose of rolling out in time. So you would probably ask me, wait, JC, does that mean that I have to sell naked puts and never sell credit spreads again? No, I'm not saying this, and I understand that it takes more capital requirements. I understand all of this. I'm just raising awareness on the fact that when you have credit spreads on, it's gonna be very hard to roll them out. And I'm just saying that it's maybe better to start selling credit spreads knowing that you're probably gonna have to take the loss anyway, because you won't be able to roll it out. And in the end, what's better? Sell 4 or 5 credit spreads and you're gonna have to take the loss on 2 or 3 of them, or selling a naked put where hopefully you're gonna be able to turn it, if I'm a loser, into a winner if it goes against you, only if you stay small, of course. And once again, I'm not saying that one is better than the other. I'm just raising awareness to let you know that credit spreads are hard to roll, so you can make informed decisions after that. And you would probably tell me now, look, when I want to open a naked put position, it really takes a lot of my capital requirements and I don't have much capital left. And I understand your pain and I understand your plan, but here are the options that you have, no pun intended. So whether you start selling naked options on low value stocks, meaning on cheaper stocks like $20 stocks where the capital requirement is smaller than stocks like on Netflix, Apple, Tesla and all of this, or you put more money into your account. And I know it's not necessarily what you'd like to hear. You would want me to say that you can sell 5 credit spreads or 10 credit spreads instead of 1 naked put and you'll be fine. But the truth is, no, it's not. And in my opinion, it's better to sell 1 naked put that maybe takes a bit more of your capital rather than selling 5 credit spreads that equal to the same capital requirements, because first of all, your exposure on the credit spreads are going to be the same in total because you have much more positions open and you won't be able to roll them out. And if you can't can't trade naked options on cheaper stocks, well, I just say save more to put more money into your account. It's maybe better to wait on the sideline, put more money into your account, save more money, and after that you'll be able to have a better start rather than rushing things and in the end losing money for nothing. And I've got nothing against credit spreads. I think it's a great strategy. I think it's just better to start with a mindset of, well, if the trade goes against me, I'm just gonna have to take my loss and move on. Because the only moment where you will maybe have the opportunity to roll your credit spread for a credit is when the price is what we call on the dance floor, meaning that your short leg will be in the money and your long leg will still be out of the money. That will probably be the only opportunity that you'll have to roll your trade out in time for a credit. If the trade goes fully in the money, after it's going to be very hard to roll for a credit and you can consider that a loser. And I hope this video made sense and now you understand a bit more why selling one naked options is probably a bit better than selling 5 credit spreads, even though you could make money with credit spreads. And if you have any questions, as always, don't hesitate to ask them. And if you'd like to join my Facebook group, the link will be in the description of the video, and don't hesitate to join. I'll see you there. I wish you all the best and see you in the next video.